Hey guys, Sean Corbett here with special guest Mike Chamberlain, who works with Stephen Earle. I've done a couple of Zooms with Stephen. He's been very open, sharing about his success helping people investing in real estate as a long-term asset option, as a alternative to the stock market. And Mike Chamberlain actually works with Steve, and he's got some really fascinating views when it comes to this space, right? So we can invest and we can retire a lot of different ways. I've tried to diversify a little bit. I'm not really excited about the diversity option in general. I don't like making things really that complicated for myself, and I'm really not fascinated with the stock market. So I can appreciate having someone that shares some of those sentiments, and he's found a space in real estate, and his space in real estate is, hey, we don't have to invest in a bunch of different things. Real estate has answers for most of all of our solutions in some way or another. So thanks for jumping in, Mike. I appreciate it.
Yeah, great topic. Hope to help make sense of it, and I concur. Yeah, it's good. Lots of different ways to make money, but to have a dependable count on it, be able to sleep at night while you're building up towards it. I've not found anything better than real estate to accomplish that goal. Yep.
Let's do a little bit of background so we can have some perspective for you. You've come from the financial planning background in general, and you were advising people on how to take their money in a safe way, invest in different spaces, sometimes more aggressive, sometimes less aggressive. And generally, was it all like hedge funds and stock market, mutual fund stuff, or is that generally what you were
Yeah, I
advising?
was a retail financial advisor for most of my career. So 2 decades ago, I started working for Edward Jones, and I worked for Fidelity Investments for part of the last couple of decades. And so for most of the career, I was helping people grow money with what most people are doing: stocks, bonds, mutual funds, 401ks, IRAs, familiar with, and a fan to some degree of all of that. But it was about 6 years ago that I had an opportunity. I've always known what real estate could do for the investor. I think that's well known out there. Most people know that wealthy people have either made their wealth or have diversified their wealth once they got it some other way through real estate, and then use the advantages of real estate to keep more of that, the tax savings, the estate planning, all the things that real estate can provide for the wealthy and for all of us. And so I made the transition over because I love what real estate can do for the individual. I always also really like the team over here at Done For You. Wanted to work with Steve and others just because I think there's a good intent to help people take advantage of real estate.
Okay. Let's dissect that a little bit because I think there's value here, right? So I'm at a certain age. I've got money in stocks. I've got money in 401ks, and I've got money in whole life insurance plans where I can kind of build the opportunity where I can take loans against it, and it grows. Probably not the fastest, but it's reasonably safe, and it has a large payout in the event something happens to me as the insurance part of it. You're really kind of focused into real estate. Now, what's interesting is that anyone that's a lot of the exceptionally wealthy people that have built real estate on their own and are not real estate, been wealthy, have built it through the vehicle of real estate. Most of the wealthiest people out there, this is the vehicle they choose. They don't go and run out and do Bitcoin gambling or do it through the stock market. Usually, I mean, you have exceptions. You have, Berkshire Hathaway people that are a little different, that have found an opportunity and learned to really maximize it and made a ton of money there. For whatever reason, it's never been exciting to me. Real estate's always been exciting. I don't know if it's because I can see it, touch it, feel it. I've got assets. I've got rental properties. Even in Dallas Fort Worth, I've flipped over 100 homes here in Dallas Fort Worth. So I've just kind of gotten into it, even if it may not be the best opportunity. I just always thought it was fun. But hearing from someone like you saying, no, real estate is a good choice. So what I really kind of want to think about is you knowing other options and have success in other options. What is it that you think that we have maybe the pros and cons of going into real estate? Like how is it better than investing in other options? What's your kind of take on that?
Yeah. So what I like most about real estate is the likelihood that the investor, if they can just get started, that's the problem with so many people, is they know they want to do it, but maybe haven't come off the base or off of the bench to get up to bat to get on base. They got to get in the game. And then if they can stay in the game, they don't have to have dramatic overnight kind of wins, but it's not get rich quick, it's get wealthy slow. But if they can do that, then they often sleep better at night and are more likely to get those long-term returns that they can be so impactful. Unlike my experience helping other people, and again, I'm a fan of all kinds of investments, but when I was sitting across the desk from people back in 08 and 09, and the S&P 500 lost 57% of its value, there were people who felt like this wasn't any of my clients, but it was out there. I've lost half of my money. I don't want to lose the other half. I'm going to pull out, and they're not there for that. What's often a V-shaped recovery, and so they don't get the long-term returns. They don't get the 10% that the S&P's average. They get 7%, which is what the studies have shown the average stock investor returns because of that roller coaster ride, the fear and greed. And not only do they not really get those long-term results because it's too adventurous a ride for a lot of people, but even if they do get to a number that they need to help them ride off into the sunset, my experience, and I've worked with hundreds of people over the year, when they've had that, I've lost half the money experience in the past, which has happened twice in the last quarter century, the tech bubble burst, the Great Recession. When they lose a third of their money when COVID hits 4 years ago, and a quarter of their money just a couple years ago in the stock market, those are drops in the S&P in the last couple quarter century, then they kind of feel like this is going to happen again in the future, and they never really allow themselves to enjoy the fruits of their labor. In other words, they might retire and they might have a big nest egg, this pile of money, but the hope is that as they start taking money out and the pile starts shrinking, that the living doesn't run out before the money runs out. And because there's always that kind of fear of the uncertainty, that what if the black swan, that I don't want my kids to take care of me or to be relying on the government. I want dignity and independence in this 2 or 3 decade retirement that I'm going to have. But yet I know that I need stocks in order to outpace inflation. And I know that stocks lose half their value at times. I saw it time and time again where they won't go out and actually start spending the money like I always wanted them to. They won't enjoy life as much because they're afraid of the unknown. But when it's real estate and it's physical and tangible, and they've related to it with their own personal property, their residence, and they believe it's going to be there for their future, then it just helps them sleep better at night. It helps them have more confidence. They helps them enjoy life more, I believe. And so that's the thing that I really love about it is lots of good ways to make money, but to actually get the real long-term results, I haven't found a better investment than real estate, just because people have more confidence in it.
It's interesting listening to you. I always take information that I'm hearing and kind of think through it. Most of your view has people in a peace of mind and emotional state, and you're trying to curb a lot of that, right? And it's interesting that you would say that they have this fear of the next crash or the next drop, so I can't spend any money and enjoy my retirement. I've never heard that before, but that's a fascinating kind of way of thinking about it because they've seen too many ups and downs. And think about it, like in the last, we've had the volatility of the stock market is incredible right now, right? It's not what it was in the 70s and 80s and 90s, and things were slow. We could see it, we could predict it, we could feel it. Now it's every like 4 to 5 years we have some incredible crash or something insane happens, and it'll start happening even faster as we have information available to us and everybody jumps and reacts, and then it affects everything else really, really fast. So, but that's all almost kind of like an emotional response.
Yeah, behavioral finance, as it's referred to, personal finance is much more personal than it is finance, right? It's much more what's going to help me sleep at night and accomplish my goals more than it is just what's going to make me money, cost me money, what's the data, the dollars, the finance. And so we often associate, and I love the fact that you have multiple ways you can benefit from real estate, as referenced here on the left column, that passive income, the appreciation, the leverage, the tenant paying off the principal, all these very real benefits, tax savings, keeping more of your money. That's what real estate does for you, unlike the stock market that maybe just grows for the future, or bonds that just pay you an income. You get growth and income plus keeping more of the money. That's all very real, and that all helps you be in a better position long term. But in my mind, those are all just features of real estate. It really is the benefit of the hope that it creates, the confidence, the peace of mind, and the aspects that allow wealth building, and of course, the position to have a legacy impact later on, that are actually my favorite things about real estate. It's not as much the features, although that's what helps people get there and stay on the ride. It's more those mental, psychological benefits that can be so effective for getting the long-term benefits. Because that we all know real estate does not always work out in the short run. When you factor fees in and fees out, when you factor in the messiness of whether a house is rented and whether the tenant's paying for it or you have to cover mortgage, when you factor all that stuff, sometimes it's a horrible investment in, let's say, a year's time. It's always a great investment in a decade's time. And so helping somebody have an experience that's better than maybe what they could on their own, but ultimately the focus is always on just staying on board, staying on that ride, so you can get that long term, because it always works out long term. And helping people have a more comfortable ride and realize all the ways it's benefiting usually helps out with that.
Okay. So we've talked about some of the positive things, and I think there are a number of positive things. What do you feel like owning rental property and things like this? And I assume exclusively we're talking residential rental property, single family homes. Is that exclusively the market you focus in? Do you have other options
Yeah,
in
yeah. What I'd say
residential?
is lots of good ways to make money in real estate in general. At times, commercial, multifamily, they all have their advantages and disadvantages, just like single family. But that's what Done For You has focused on: 3, 4 bedroom, 2, 3 bath, good quality home, good neighborhood. Top of bell curve kind of in demand. The price is not on the high end. It's not too hot, not too cold, not high end luxury, not low end C class. That's what we focus on. Not that that's the only way to make money, but that's usually a more comfortable experience. Yes.
Yeah. I mean, that's kind of like we can try to go for the 12, 13% return, but we're good at 8 or 9 and know that
Mhm.
we're going to get 8 or 9
That's
pretty
right.
much
Yeah.
99% of the time. Um, what do you see as any negative aspect of investing in real estate versus some of the other avenues?
Yeah. So of course, real estate is often, I used to sell against real estate, right? When I was sitting on that side of the desk with Edward Jones or Fidelity's, an investor would come in with real estate and I'd give them reasons to want to sell that and bring the money over to me because I either didn't fully get real estate at the time or I couldn't be compensated with the real estate. That's often what you get in the financial planning world. Of course, they get paid depending on how much money is under management for them. And so there is some of that consideration as well. And so, it's thought of as illiquid, it's thought of as unsafe, it's thought of as something that you can do real damage in. If you get into real estate, and I've heard this actual experience, somebody who got a property here locally wanted to be their own landlord, not pay a property manager the override fees and the due diligence to do the background on the tenant and all the things that a property manager can bring to the experience. They just wanted to do the managing themselves. And they got somebody in that they never got a single payment from, took 6 months to get them out. And when they got them out, the place was a disaster and they had to sink tens of thousands into fixing it up. These are the horror stories you hear about real estate, which are very real, which do happen out there. And so if that is the experience somebody has, and then they throw up their hand saying, I want out, and now you paid a fee to a bank to get the loan, and then you're going to pay a fee to a realtor to get help selling it. That is a negative aspect of real estate, getting in and getting out too soon because of the extra fees that are associated with it.
Sure.
It is not always a good investment. But if they'll stay in for the decade, if they'll stay in, Warren Buffett talking about stocks, which I refer to as just another kind of ownership investment. You can own a piece of a company, or of course, in this case, you can own real estate. They're both ownership versus just lending your money out like to a bank or a company. That's a much more conservative thing to do. But the ownership investments, Warren Buffett said, if you're not going to own a stock for 10 years, don't think about it for 10 minutes. And we tweak that a little bit with this kind of more conservative single family homes. If you're not going to own a single family home with our help or on your own, either way, for 5 to 10 years, don't think about it for 5 to 10 minutes. So that time is an issue. But as far as the liquidity, you can get cash out refinances. If you've had a home that's gone up, you can do that within weeks time and get chunks of money tax free deposited into your account. As far as safety, yes, if you do it on your own, you're going to make mistakes. But if you can team up with people who have done this 100 times before, flips yourself in your backyard, or thousands of homes that we've helped people purchase, it's somebody that can add that experience and expertise. It mitigates that risk and increases the safety of it. So there's certainly negative things that can and will play a factor. Clients, even with our help, they get the messiness of real estate. We don't help them avoid all messiness, but hopefully they can have a better experience and stay on board and then get the long-term returns again.
Well, I know the model that Stephen has for advising and educating and doing this for them and creating that opportunity, a lot of the risks are hedged against. You can't eliminate all risk, but if you buy a certain type of property, like a brand new home, um, and you know pretty consistently what you would expect in rent value and things like that from it, and they invest a certain amount in the front end, they're going to get a really good rate in terms on the back end. And there's a whole lot of things like that that control a lot of the risk. I know based on the model you have. For you, what, where are you at? Do you buy rental property? Do you have stocks and bonds? Do you have a
Yeah, I
401k?
have, I don't hold any bonds. I have asset allocation funds that the money manager may have some bonds in it, but it's a small part of it, of the overall portfolio. I bought my first investment property after I started working for this company 6 years ago, and have since expanded. And so I'm an all of the above kind of guy, but the serious money, and this is something that you talked about before, is something I used to say as an advisor, the money that you got to have, the money that you need to depend on to be able to stop trading time for money and start living passively, which of course you have to have something that makes you money while you sleep in order to ever retire, and not be dependent on just the government. That serious money has got to be more diversified or be in a more secure investment like real estate. And so that is the majority of what I'm doing now. And it's what our clients often have, diversified portfolios where if they're business owners, they might have a third in the business, a third in traditional investments, and a third in real estate. If they're not business owners, it's often more like half and half real estate, half other things, 401ks and whatnot. But it's definitely something that supplements and often supplants whatever somebody else might be doing with their money.
Okay. Let me ask you this. What if you combined owning stock with real estate in the sense that, you're just buying a piece of paper, right? You have ownership, you have something, um, you're not getting the touch feel or anything. It's just buying something on the internet, buying through E-Trade or whatever, and you buy that stock. It's there's this big separation for people that I know for me, whenever I get in and I start trying to bring in investors, say, hey, you want to get into flipping with me? How about you go fund it? And then I'll take care of everything and I'll make the profit. I'll pay you for your money. And most of them just like, it doesn't sound very exciting to me. I want to take a part of the profit. They want to get that whole conversion experience where we take ugly, we make it beautiful. And everybody wants to flip houses, I feel like. And they want to take part of this tangible element. Buying, stocks and stuff is fun watching the money because it's live. That's kind of fun. But it's not quite as compelling as an asset, I don't think. Now, I'm saying a lot of different words to kind of paint this picture. What if instead of buying real estate, we bought like a note and we got away from the actual asset and we were owning it and we're renting it out? Instead of renting it out, we eliminated all of the risk and we owned a note and earned whatever we can hedge against it. So we get a discount on the note and then we collect whatever interest rate was originally agreed to. It is not near as fun. It's very hands off and it's capital intensive, but it's kind of like almost like having rental property without any of the risk or work. Have you thought about that aspect of, and it's still in the residential real estate space, I would say, but you're basically the lender in place of Wells Fargo. You buy their note, 10% discount. You take over whatever interest rate they have set up. And if they default, great, you get paid earlier. And if they don't, then and they just get a refinance or sell it, great, you get paid earlier. I mean, what do you think about the note space?
Yeah, it's absolutely part of a diversified portfolio, right? That diversified portfolio, and it's a kind of thing where if somebody were to ask me, should you have money in a loanership position, whether it's loaning it to the bank and it's sitting in a savings account or loaning it to an investor that's going to go and develop and pay you a higher interest rate, is what we're talking about here. It is absolutely part of a diversified portfolio. People should have money in a loanership position, and especially depending on a person's temperament and their time frame, it could be the right place to have more of their money. If you're looking at total return over long periods of time, if you can stay on that ride, it may not be the biggest return on the investment that way, but it is a better return for somebody who has a shorter period of time, let's say years instead of decades. It's a better return than sitting it somewhere else where you still have guarantees, of course, with the title and other things that can obscure a position. And it's absolutely part of a diversified portfolio. So it is a good way to participate in real estate, and it's a diversified part of a portfolio. So it's something that we have had investors that had served that role before, lent us money and got a fixed rate of return, as we would then go and partner with the companies around the country that would fix up homes and then sell them to investors. It's not what we do now, but it's absolutely a good way that some people are able to participate in real estate.
It's fascinating. Your buyers can come in, and most of them don't want to or have cash to buy out houses outright. So they're going to finance. And I know you guys do lending, but there's certain buyers that don't fall within, right? Self-employed or whatever. They don't fall within the general guidelines of a Fannie Mae, Freddie Mac loan. So they don't get quite the interest rate, but maybe the approval process is different. You could actually take the note on those with
Yeah,
the
absolutely.
house's collateral with 25% up front. That's a pretty safe bet for you.
It is. Yeah. No, it's definitely a good way to participate. And it is something that's becoming more common out there, whether it's individuals doing it or debt service loans, DSCR loans. We have several clients that have used that approach because of the reasons you talked about, whether they get to 10 properties and they're not allowed to have another conventional,
Uh-huh.
or they don't have the income because they're 1099 not W2, or the debt to income ratio doesn't match. Yeah, there's definitely other good ways to finance and get them in the game or help them expand a portfolio. Even though the points may be a little bit higher, the cost may be a little bit higher, the numbers can still work. And that's a good way for them to get in the game.
Are you a licensed agent, EXP?
I'm not. No, I'm not.
Okay. What's your role at DFY?
Portfolio optimization manager is the actual title. So I work with clients after they purchase a property to talk about what the experience is like moving forward. And we do annual reviews with our clients. So we're always proactively reaching out to them to give a perspective on their home and the market. I help with that. And then planning, somebody who wants to accelerate, the net result of what they're trying to do with real estate. I can help them make sense of that, ways to get more, ways to do it faster. Financial planning kind of conversations, but focused on the real estate part of their portfolio.
Yeah. So it could be, hey, I want to throw another 50 in. What do I have on what equity do I have? Can I refinance out? And then you'll do the refinance, take it and bundle it, and we can go buy two properties with it, kind of deal.
Yeah, a lot of our clients, over half of our business actually comes from repeat business. So
Yeah.
clients that got started, they want to see if it would work. When it does work, they either come back with new money, or if they don't have new money, they wait for the home to go up enough in value and the principal to be paid down just a little bit, not a lot, because most of it goes to interest those first several years, but still to get enough equity, lazy equity, that they can put to work and go in and buy in a second one. So over half of our business comes from repeat. Lots of clients have gone from 1 to 2, 2 to 4, 4 to 8 over the last 15, 16 years that we've been helping them do this, just from the homes themselves purchasing other homes. That's right.
Little scale, right? I mean, every year you're going to start getting considerably more opportunities
That's right.
because more people are now reaching that fifth, sixth, seventh, eighth year where they can cleanly refi with no money out of pocket and then convert it into another opportunity. So now you have two properties growing. I use a totally different calculation. I think really, really simple. Steve's got a kind of a complicated capitalization, all these things that he puts into it. I think of, my main, apart from cash flow, I look at the three numbers that affect your value, right? So you've got principal buy down, you have appreciation, and then you have the equity, which is the difference between your payoff and what it's worth, right? I look
Yeah.
at that growing at a combination of both principal reduction and the appreciation. Roughly for us, I think it's right about 5%. I mean, it's a very safe number. It's not hard to hit, reasonably expected, and maybe even better. But on a $300,000, and I've actually, just so you know, since I've met Steve, I've actually sold 7 new builds.
Oh, wow.
And because I know I did it the hard way. I did the Burr method. Okay. And the Burr method is where I got involved and I did all the work. I did what you do, but I did it on the Burr method, which means I have to go
You
find the house,
accelerate
renovate the
it, yeah,
house.
which is a great way to make money for people faster. Sure.
But
But a
the
lot more work.
problem, well, and it's a little less upfront and they get more equity, right? Because you buy new build, you don't start with equity. But I list your own equity. You can start with your own equity. But Burr method, though, that means I'm finding the home, I'm renovating the home, I'm refinancing the home, I'm even lending the money. Like I'm doing everything. and it's very intensive. It takes a lot of my time and hours and effort. And then we'll eventually refinance and I'll find them the tenant. So I take care of all of it. Doing it this way, you just find a new build and then find them a tenant. And there's lending. You guys do insurance and lending and other things, which is pretty real clever. I forget where I was going with all that. I do it the hard way. Oh,
What I just say to that real quick is again, I love what real estate can do, and whether it's wholesaling, whether it's BRRRR, whether it's buy and hold where we fit in, there's going to be clients out there that fit in any one of those segments, and I love that you're able to help give them a solution for that. That's great.
I know I was going to ask. So at 25% down, what do you see your average refinance year is?
Yeah, so we've had two time periods. I would never tell people to expect this, but in our
Yeah, I mean the
6 year,
market's changing like crazy.
yeah,
COVID totally changed all of our calculations.
yeah,
But go
two
ahead.
time periods where clients have been able to turn one into two in about 3 years. That's not normal. Do not expect it. 5 to 7 is the expectation. If we get kind of normal appreciation for the markets that we're in, we're in markets where the population's growing usually 2 or 3 times as fast as the national population is. You have that there in the Dallas Fort Worth area. You're growing about 4 times as fast. I was looking up the numbers before the call here, but your population is growing about 4 times as fast as the national average. Dallas Fort Worth has I read something months ago that talked about it becoming the third largest metropolitan area in the nation by the end of this decade. So right now it's New York, LA, Chicago. It's going to be New York, LA, Dallas, Fort Worth. That population growth, because there's good jobs and the economy is attracting people, all the things that that can help get better than average appreciation. That makes it very attractive to invest where you're at. But we're helping people invest in markets around the country where those macroeconomics kind of make sense and work out. And so now I'm struggling. I'm trying to remember the question actually.
It's the
Question
five
again?
to the year you were talking about, the year that you can
The
now
5 to 7 years.
refinance.
Yeah.
Yeah.
If you get average appreciation, 5% is what all of our markets have gotten over long periods of time. 5% or better, and that no guarantees that will continue. Then 5 to 7 years is the expectation. Obviously, no guarantees, depends on what happens, but that is very normal, and it's happened quicker than that too, but don't expect it.
You're in Utah with Steven, correct?
Yeah. Mhm.
Okay. Are you in Texas?
Yeah. Yeah. We're in the Dallas Fort Worth area, actually.
Okay.
And so we've helped people buy long-term rentals there, and we also do a little bit with some midterm stuff that we've started up in that part of Texas. Yes.
Very cool. I've got about 10 markets in Dallas Fort Worth that I target that are under 300. And I've got a lender I've partnered with that does 15% down payment loans. So it's a little bit lower bar to reach. Now, I'm not looking for cash flow. I'm looking for zero.
Mhm.
I'm not necessarily looking for cash. I don't think cash flow should be even a priority today. We're building equity on someone else's money with very little down. I think that's a strategy that's very, very clever.
I love that for the person who gets it, whether it's they get it on their own or from their own research, or you're helping to educate them, or we try to. For the right person, this isn't for everyone, but for somebody who gets the power of leverage, putting less down, leverage is what makes this so dramatic. 10 years after you buy an investment property, you won't even remember what that first year's cash flow was, because it's such a small part of everything that property has done for you. Turn one into two, tax savings, principal pay down, all those
Yeah.
things that you're getting while you're maybe getting break even cash flow or $100 or $200 cash flow in our case, because they're putting more down. If you can maximize that leverage, put 15% down for the person who gets it, who doesn't need that kind of injection every month of a little bit of positive cash flow. If they want to maximize their total return, that's the way to do it. 15% is better. Not getting the hits along the way, but you're getting the bigger total return long term. Absolutely.
Very cool, Mike. I think I've covered the things I wanted to talk to you about, like including what you're doing and why you went away from doing financial planning and other areas of real estate for future people looking to retire and moving into real estate. I think it's a fascinating component. I love that you've had that history, right? Because you can have that conversation with people. This is why it's good. This is why you may consider maybe divesting from other ways. Maybe your return isn't 2 or 3% higher, but man, I tell you, it's a solid aspect, and you can sleep. You can sleep at night because you're going to count on the probability of this working is a whole lot more consistent than any other options out there. I think it's a really good way of looking at it. How do we find you, Mike?
Yeah, so dfy-realestate.com. dfy-realestate.com is the company I work for. My email is just simply Mike at MIKE at. And I'll tell you, just to echo what you said, real estate, I've had clients give me the messiness, the mortgages they had to pay for because the tenant didn't, the fix-ups. I've had the lawyer costs, whatever it is. I've asked people to give me that. Every time a client's owned a property for 5 years or more, the total return's always been more than anything I help them do as a traditional advisor. It's usually double, sometimes triple the total return when you give it time. So yeah, I love what you're doing to help people invest in real estate. It's powerful if somebody can get started and then give it time and then grow it. It's a pleasure to chat with you today.
All right. Thanks, Mike. We'll do it again. I appreciate you.
You bet. Bye now.
All right,